Today, we're going to be talking about the current trends and expert insights in the dental practice market with Maria Melone. She's a CPA, a certified valuation analyst, and really today we're tapping into the leading M&A advisor in healthcare, also with a deep knowledge of dental industry located in Boston, Massachusetts. Her mission is to help both individual businesses and multi-site groups, which we'll talk more about, navigate the complex landscape of capital or strategic transactions. Welcome, Maria. How are you?
Great to be here, Melissa. Always a pleasure to join you on your podcast, and looking forward to this conversation today.
Yeah, we kind of keep you coming back to give us a good idea of what's happening in the market. And I think today is going to be kind of a similar situation. We thought a good title would be Current Trends and Expert Insights in the Dental Practice Market. And what we're going to cover today is really a bunch of concepts that are happening really in the mergers and acquisitions space of dental practices, how they're being rolled up, what are DSOs, and other various topics in this industry. So, to kind of tee it up, just a broad question would be what's really happening in the dental practice market or in the dental industry from the concept of transactions, M&A, and advisory kind of area. What are you seeing take place via mergers and such?
Yeah. So in the industry today, we're coming out of a period where there has been a bit of a slowdown. We saw with the spike in interest rates really impacted a number of groups fairly significantly in terms of impacting basically their cash flow and ability to continue to grow. And so for the last, say, year plus, we've definitely had some of the larger DSOs sitting on the sidelines in terms of their growth. And at the same time, we also saw a number of, semi, I wouldn't say the largest, but fairly large DSOs really having some significant financial trouble. In a couple cases, assets were turned back over to the banks. And so that certainly, I think, created a bit of pause for many buyers and, created an environment where I think in today's market, buyers generally are being a little bit more judicious, both in terms of values that they're willing to pay and just, choice of transactions they're willing to do. One thing in particular that we've seen is a pretty big shift in the transaction structure in terms of how value is conveyed to the seller. Up until about, a year ago, I would say many transactions were 80% cash at close, 20% in some sort of either equity roll, deferred payment, note. And in some cases today, we're seeing that having shifted to a 50-50. So 50% cash at close and 50% either an equity roll or some other form of note or deferred compensation. And that's a pretty big shift and has a pretty big impact on a seller and what they're able to do with the value of their practice or business.
And because it's shifting to more like a 50-50, are you seeing more dentists question whether it's a good situation to sell? Is that requiring them to stay longer for the other 50% or even have to stay for any portion of time and not retire? Like, what are you seeing in that side?
Yeah, so that really varies quite significantly depending on the buyer. So, I would say, generally speaking, most buyers want sellers to stay on for some period of time. Now, if you can commit to staying for 3 to 5 years, you're probably going to get the best valuation and the best transaction terms. If you're only willing to stay for 1 year, you may be able to get a deal done, but it's certainly not going to be at a premium valuation or deal structure. And, in terms of that equity portion, now that we're, getting close to a 50-50 split, one, it's even more critical for a seller to truly understand who they're partnering with. What is the experience of the management team that's driving and building the company? What's the experience, if there is one, of the private equity firm that's backing that organization? And then what are the terms and conditions of the equity? So there are times when a buyer may say, at our next turn, you are able to liquidate some of your equity, but we're only going to let you liquidate 50%. There are some buyers whose equity is tied to actual employment. So that would mean that you'd have to stay employed in order to hold your equity. And if you wanted to leave before another turn, you're going to lose out on some of the appreciation of the value of that equity. So, there's many terms and conditions associated with that equity role that is really, really critical to understand.
Okay, so if we're looking at trends and dentists are considering selling their practice, I think that we can start a little bit back, because some of the things that you're talking about would make me think that if a dentist had other dentists in the practice, or if it was like a multi-dental practice, that would be, have a little bit more, because that's a management team, right? You're not just having one retiring dentist. There may be other people. Are there other things that dentists are in technology? I know that a lot of, practices are really moving into more technology and more like sleek looking offices and practices. So what are you seeing as these trends, as the dentists start selling their practices? What are they looking for? What are you seeing, these older retiring dentists that have old practices, or are you seeing these younger dentists grow them up and then sell them, or what's the landscape look like in that space?
So as it relates to a group practice, where you have multiple providers, maybe multiple locations, that certainly can afford a seller a little bit more flexibility in terms of what their role is post-closing. And it's really going to, come down to how integral is that owner to, the operations of the business, the continued performance of the business, and potentially the growth. We've certainly worked with clients where there are multiple owners, and often in those cases, you have a wide range of ages of that ownership group. So obviously owners have different, are in different stages of life and have different interests in terms of what they want out of a transaction. And so in those cases, oftentimes those older dentists, maybe they don't have to commit to the 5 years because we know this younger, group is going to, carry the baton forward and be able to keep things moving. So that certainly can afford some flexibility to a seller. If a seller is primarily non-chair side, same sort of parameters would apply, in that if that, seller has a really strong, executive team that, again, can take the business with the new partner forward, then, that seller can likely limit the amount of time that they would have to commit to staying post-closing. In terms of other things that we're seeing, when we look at, say, solo practitioners, it's been very difficult in certain cases, and certainly in certain geographies and certain practice sizes. So, more rural, smaller practices. It's nearly impossible to find a buyer for that type of practice. And, I think some of that is due to the debt loads that students are carrying coming out of dental school. I think it also has to do with a shift in mindset, where we're seeing a lot of the younger graduates don't actually want to outright own their own practice. They want to have a much better work-life balance, and in many cases only want to work 4 days a week. So it's hard to be a practice owner if you're only going to be working 4 days a week, with all of the management burden that comes along with being a sole owner. Not to say that those transactions aren't happening, but it is certainly becoming much more difficult.
Well, and I wonder, we've seen some transactions where the dentist may or may not have been ready to retire, but needed to sell their practice for other health reasons and other complications. Do you see any of these companies coming in and maybe buying a practice and then putting in a young doctor or a newly graduated dentist into those situations, or do they really need to, have the dentist stay in place to train some other dentist? Like, what is that recruiting even process? Because I think that is some of the difficulty. Are there enough dentists coming out of school at this time, or are there any trends there?
Yeah, I don't know that there's an issue with the number of dentists, at least at this point in time and in the near future. But I think if you looked at, obviously there's population growth, and on top of population growth, people are living longer. And not only are those two factors are important, but more people today have their natural teeth for much longer of their lifetime. And so there's just a lot more teeth to take care of. And so, I think there could be a time when that really becomes an issue. What we're seeing now, though, is, again, the younger generation, I think, is more focused on lifestyle. And so getting a young graduate to commit to a rural market is quite difficult.
Yeah.
And most of certainly the larger DSOs, the top 25, and then probably from 25 to 100, have some sort of ongoing recruiting campaign or relationships with dental schools, so that they have direct access to potential grads. That being said, there are some groups that do not want to hire new grads, and then even those that do, I think, would be reticent to put a new grad in a practice by themselves. They would typically want them to work closely with an experienced senior doctor before they were, responsible for their own location.
So when we're looking at these transactions, and they might be solo practices, they might be multi-doctor practices, I think that for the most part, where I think people misunderstand the dental practice industry, or the dental industry in general, is like, who are some of the buyers of these practices? Because I think our normal brain says, well, another doctor is buying another practice and having multiple locations, right?
Yep.
But isn't, like, really, this has gotten a little bit more complex in recent years. And maybe you can explain, like, a doctor buying another doctor is not really even the only option anymore, but it may not even be the most popular option, right?
Correct. Yeah, I think one misconception that I'd like to address is value of a solo practitioner. And oftentimes what you hear is that groups pay more. And really, that isn't exactly true. The issue comes down to financing. And so most traditional banks that are lending in the dental space are limiting the amount that they will lend as a percentage of collections. So in many cases, a bank will not lend more than 80% of collections, of the prior year's collections. The reason why people say, the DSOs pay more is because the DSOs aren't constrained by traditional banking relationships. Because of their sophistication, they have different banking relationships and access to a much more significant level of capital. And so from that perspective, a DSO is appropriately valuing a practice based on a multiple of EBITDA, which oftentimes results in a valuation greater than 100% of collections. So, I just want to make it clear, it's not that, DSOs are willy-nilly just paying more for a practice. They're basing, their valuation decision on sound financial valuation metrics. They're just not hampered by their ability to finance, which is what we see with, many solo practitioners. And especially in cases where you've got a very profitable practice, or even 1 or 2 or 3 locations, the value that you're talking about because of your higher profitability is almost always going to exceed that 100% threshold. So that's a, something I definitely want to clear up, that I hear a lot of people talk about.
Well, and even according with that same discussion about financing, I think that's why a lot of solo dentists have shied away from selling their practice in some cases, or initiating that process, just because there is a high likelihood that they're going to have to seller finance that deal. And I think in some cases they're like, well, if I have that risk, why don't I just continue to run it as opposed to do anything else? But we've talked about this concept of a DSO. And I think that's, so you can certainly address how sellers are having to finance, but also we may need to just take a step back and say, what is this concept of a DSO? And how is that structure kind of connected to private equity, or conceptually, like, let's draw these pieces, because it can be doctor to doctor, and that could require seller financing, which may not be appealing to somebody either retiring or wants to move and just change direction, right? So maybe we needed to step back and talk about these DSOs.
Sure. So DSO is just one way to describe what we're going to be talking about. Many people have tried to put their own spin on the term DSO, and I just want to be clear that we're all talking about the same thing. And so really what this structure allows is, in most states in the United States, a non-dentist is not allowed to own certain assets of a traditional dental practice. And those assets are typically the patient base and the provider contracts. In some states, you get into employee status, and in some states, hygienists and assistants also have to be employed directly by a dentist or a professional corporation. So that varies some. And then there are 2 states where you can be a non-dentist and own a dental practice. So the origination of this structure was to allow for non-dentists and dentists to become partners. And the non-dentists were typically, business-minded people, to help the dentists really become more productive, more efficient, and operate a better organization. And I know things have changed a little bit. I know a lot of dental schools today are offering sort of management courses, or at least a little bit of curriculum around, how to manage HR issues, things like that, financial statement education. But for the balance of a dental grad's education, most of what they're learning is how to take care of people's teeth. And so there can be a big hurdle or burden for a practicing dentist to overcome to really be very successful. One interesting statistic specific to dentistry is the fact that over 80% of dentists are embezzled from in their career, which to me, obviously it's shocking, but to me that really speaks to their lack of, ability to just oversee operations of the business, whether it's lack of knowledge or time or interest. There just aren't typically those checks and balances that you would typically see, from a well-run organization, to protect that.
That is
So,
that's a fascinating, but I mean, that's kind of why DSOs came into play. I think originally they probably thought that they could just be the marketing or the admin or the, making doctors efficient. And then they started maybe buying up practices and rolling them up into, multi-location practices. And realistically, like there's a decent model for a solo dentist to make money. It's just that also some of the technology now could be more expensive. Like it's
yeah.
not as easy. And then the certification or other. Do you see any specializing, like any sort of specialty areas that are really taking off more that even dentists are getting into, or that are more saleable, if you will?
Well, just to back up for 1 second, part of um, the origination of this consolidation in dentistry happened at a time when there were about 6,500 dentists retiring every year and only about 4,500 coming out of school. So you had a supply-demand inequation in regards to that. Additionally, insurances were starting to really become more prevalent in dentistry. And in addition, as I mentioned earlier, students were coming out with, at that time, it was, I think, over 250,000 of educational debt. And then the last component would be the technology. So opening up a practice was becoming more expensive. So you add all these factors up and you've got, downward pressure on revenue, upward pressure on expenses, the business model itself becoming more complicated for somebody that at that time really had no business acumen. And so that's really what started the consolidation efforts. And, even at this point, I started in the space in 1997. Even at this point, it's hard to say. We don't have great statistics, but I think most people would say we're somewhere 35-40% consolidated. So there's still quite a bit of opportunity for groups to grow, for new groups to form. And, one thing in the last, say, maybe 5 to 8 years is we have seen a trend, towards specialties. So there are a number of oral surgery DSOs. There are some pediatric DSOs, orthodontic DSOs. There are some DSOs that are orthopedo oral surgery. So that's been a bit of an interesting trend for me in particular, because those specialties are generally referral based. And so it's kind of interesting to me that they're deciding to kind of separate themselves, go out on their own. And whereas if you grow a group that was general dentistry based but added specialty to it, you've kind of got a whole ecosystem, right within your four walls of services to provide.
Is that what you've seen? Have you seen that buyers are looking to roll up these practices or DSOs or multi, that they have them in a network? Are they, is the market moving towards kind of networks of dentists to make them more efficient, or where do you think they're going? Um, and what are buyers looking for when they're looking at these practices to be a part of something that maybe is a group practice?
Yeah, I would say today's buyer is probably more so in the past looking for solid assets. There were buyers in the past that were willing to sort of take on turnarounds. And I think with the current economic environment, there are less people interested or willing to take on that kind of workload. And I also think that there are definitely new buyers. I'm talking about people interested in forming groups like almost every day. I mean, every conference that I go to, I'm always surprised at new groups, that I've never heard of, having been in the space for so long. And so there still is an interest and an appetite. There are certainly entrepreneurial dentists who are willing to take this path. And, I think what's going to be interesting is, for a number of years now, I would say at least 10 years, there's been talk of the mouth body connection. There are some groups that are more forward thinking and trying to incorporate, more health sort of metrics or tests into their practice, because many people feel that patients will likely come to a dentist before they'll go to a doctor. And so, maybe you can identify an underlying issue, given that the person is sitting in your chair with, a simple either blood test or saliva test. And so, I'm really interested to see what happens a little bit more longer term. Are we going to get back to some sort of consolidated, medical dental approach, which I think could be really interesting?
Yeah, that's fascinating. I haven't heard about that. I'll have to look a little bit more into it. I think just shifting a little bit, because we've talked a lot about the market, and I deal with a lot of dental practices in divorce and or from a valuation perspective, and you kind of have the perspective of the market and also the perspective as a valuator. And people talk about value drivers, and I think it's sometimes like a an interesting term, but people associate that to certain things really start to drive the value up. What are some of those things in a dental practice that would get a higher dollar in an exit, and that really either valuators could be looking at, or even doctors and dentists could be looking at, what could they be doing proactively that is going to result in a higher exit, or is more valuable even as a going concern, right?
Yep. Yeah. I would say the three biggest factors are growth, retention, and management team. So in terms of growth, you're looking at historical and prospective growth. And that can be either or there's three ways to grow: organically, acquisitions, or de novos. And so when you think of those things organically, what does that mean? So you're either adding hours, providers, or services. That has the best sort of bang for your buck, because you're leveraging your already existing, fixed cost structure typically. And so that's probably going to have the best impact to your margin or your EBITDA or profit level. In terms of the acquisition and de novos, it's important, to be able to demonstrate that you are experienced and successful in either of those paths, and also to show that you have a pipeline for future. And so what does that mean? So in an acquisition world, it means that you've identified certain targets, or you're in various stages of conversation or negotiation with new locations, new partners. From a de novo perspective, that would look like you having a site map, having sites either already identified and or maybe under lease or under construction. But growth for sure is the biggest driver. Next is the retention, certainly of your doctors and hygienists, the providers. But it's equally as important to see retention in the team, which all suggest good culture and likelihood of continued performance of the business if people are going to be sticking around, and you're not going to be in this cycle of having to retrain and reintroduce patients to new providers. And then, lastly is the management team, and the importance of the management team gets back to the growth. So, if you, and this can be a bit of a fine line, especially when you talk about, mid to larger size groups, because most groups are trying to run pretty lean to maximize their earnings, and building out your senior team, your executive leadership team, can be a significant hit to that profitability. And so it's a balance of, deciding, do I bring on that CEO now before I transact? Or do I go to market without the CEO, knowing I'm going to take a little bit of a hit in valuation, because the buyer is going to say, well, in order for us to continue your growth path, you're going to need X, Y, and Z people on your team. And so we're going to burden, our valuation with those costs, because we feel that that's necessary for the business to continue on the path that you've brought it to.
Yeah, I think it makes perfect sense. And I think that a lot of times people would think that the management team is the office manager, or having other customer kind of care professionals. So to hear you say a CEO and really having multi, locations or things like that, I think is interesting. Are you seeing specialty, like, is it still, for pediatric, or if you're looking at orthodontist? I don't know how Invisalign has affected that space, or if that's still, you would still get that kind of product at the dental offices. But are you seeing any other trends or new things happening for new graduates, that they could be mindful of? If people are building new locations, that would assume that there's options for new graduates to have a nice job. We were speaking the other day with some clients, and I think one of the professionals said, they only work 4 days a week. And I'm like, yeah, but that's pretty normal for a dentist. Or
Well,
what does it look like now?
yeah. I mean, I think that's pretty normal for an experienced dentist, but when I started, my career working with dentists, most dentists would tell you they started 6 days a week, even 7 days a week, because they were building their practices and, they wanted to be available. Um, and things have changed. I mean, even, after 2008, there was a shift to recognize that patients were very concerned about their employment situations. They weren't necessarily going to want to take time off of work to come to the dentist. And so we started to see a shift of extended, expanded hours, early mornings, later in the evenings, and, even on Saturdays. And so, unfortunately, I would say most younger doctors today aren't interested in putting in that amount of time. Again, they seem to have a different philosophy around work-life balance. But one thing I think graduates can be excited about is we've also seen a dramatic shift in the opportunity to have an equity position, even as a younger doctor. Early when this consolidation first started happening, selling doctors typically did not have an equity position. They sold their business and they stayed on and worked as an associate for a number of years, and they were, driving growth of these businesses, overseeing the staff, but not participating in, the improved performance of the businesses. And I think I want to say maybe in 2012-ish, I think private equity firms in particular started to recognize that there needed to be a more aligned incentive with not only the selling doctors, but doctors overall in their organization. And the way to do that, the way to create some stickiness, some incentive, some alignment, was to create an equity program. And so, there are groups today that are owned 50% by the doctors in the group and 50% by either the private equity firm and or the management team. So that's a big shift. And it's a big opportunity for young doctors. And I think it also is potentially why younger doctors are not necessarily interested in outright owning their own practice, because they can join a group, still have an equity position, but not have to worry about all the management headaches that go into, running and operating a dental practice.
Yeah, I think there would at least be the efficiencies of marketing and things like that that could be shared even if you were solo practices. But this has been a lot of really amazing information. Is there anything else that we should know as valuators or professionals out there, assisting dentists or discussing? Because I guess, and one thing that we had talked about that we were going to talk about, we didn't, was in divorce, in valuing some of these things for divorce, we get into personal goodwill and we get into enterprise goodwill, and it's really an allocation issue. Are you seeing any market multiples in these dental practices, or are you seeing any allocation of, this to personal goodwill in any of these practices, or non-competes? Those are kind of some of the areas that we also deal with that kind of create, it's almost like they create this little stickiness to really understand the value. And then when you have it in a litigation context, it's sort of like, then everybody's fighting about these sticky issues. Do you see some of
Right.
these in what you're looking at?
Yeah, definitely, for sure. And I think first of all, maybe it makes sense to just point out that the work that I do and the work that you do can be very different, even though we're doing the same work, because there are certain parameters and Yeah, I guess parameters is the best word to describe how you look at valuation in a litigation setting. And even certain states have different parameters as to how you look at things. Excuse me. And, what I'm doing when I'm working with clients is really looking at the market and how the market forces inform value. That's not to say that we don't have a sense of where value is going to end up, but there's still market conditions that we may not be aware of that can also drive valuation. One example in particular that I can think of recently is we were working with a client and we had one buyer that was, in terms of a multiple, probably three or 4x higher. But that was because that buyer had, this was a specialty practice, and that buyer had a large general dentistry group in the area and could leverage that. And so they had more incentive. There was more value that they could see coming out of that acquisition than, say, somebody just buying that specialty practice and keeping it as a standalone specialty practice. So those are the factors for sure that you in your world wouldn't encounter. But in terms of the allocation, generally speaking, with dental practices, the fixed assets of the business are very small relative to the actual value of the business. And so, when you think about the allocation or what makes up the value, oftentimes we're seeing about maybe 20% or even less is assigned to tangible or fixed assets. And the balance is assigned to intangible. And that can be, personal goodwill. It can be customer lists. It can be staff tenure, phone number, website. I mean, you can go down and list any number of intangible assets that you can try to assign value to. And, that we touched on this, you and I did before we got on the official recording, but, some portion of every practice is tied to the provider. I think most people think of the provider as the doctor that owns the business, but you really, I think, also have to think about the hygienist as well, because they also have a very oftentimes deep relationship with the patient base and can have a direct impact on where patients, decide to seek care. The other big ones, as you touched on earlier, the non-compete, which can be tricky, I think, from a valuation perspective, because in a lot of states, there's some new trends and new laws very much restricting non-competes. And when you talk about, especially a DSO transaction, there's typically two levels of non-compete for the seller. There's the non-compete relative to the management of the practice and the ownership of the practice. And then there's a non-compete relative to the practice of dentistry. And typically speaking, the practice of dentistry piece of it is more difficult to be enforceable, especially over a large radius or a long period of time. Whereas the management aspect of the non-compete is the one that probably holds up more, but may not be as limiting to a seller, depending on what they're hoping to do post-closing.
Yeah, I think it's interesting because how I was explaining it to a judge recently was that the value and the price, like it's almost this old conversation of value versus price, right? How do we price it for the market to go to market, and what's the value either to the holder or to somebody else, right? And all of these things in between. but you could have two people that look at the value as the same, but it's allocated to or connected to the person, the doctor, the client base, and all of those intangible assets. And normally we're coming in and giving an opinion on how we allocated it as well.
Yep.
So even in your practice of selling these dental practices, you guys are keeping metrics on non-competes. You're keeping metrics on the sale price and what they sold for. So, and these are being transacted probably even more so than other doctor practices can be transacted at this time. But what other kind of market concepts would we have no clue about that you think are fascinating? And I'm going to scroll some information about you as well. So if you want to also give us some information about you, but where is your focus right now in this space, or what is fascinating you about this space? Because I think that would be interesting as well.
Interestingly enough, I am looking to explore other healthcare spaces. I think the dental space is still very interesting to me, and certainly where I have the majority of my experience at this time. I think there's still plenty of opportunity for consolidation. As I mentioned earlier, new groups are popping up all the time. And I also think that unfortunately, there's still a lot of bad information, that is put out into the marketplace. And so I would strongly encourage anyone, especially in the dental space, that's thinking about transacting, just to make sure they're relying on credible quality information, data, statistics, before they go to market, and to make sure that they understand, valuation is an art and a science. And there is a lot of art, I think, especially in dental, that factors into why somebody gets a 7x versus a 5x, for example. So
yeah, what are some of the other areas that you guys are kind of going into?
it's really not limited. I mean, we're active in the med spa space, optometry, ophthalmology, derm. I think urology, cardiology, orthopedics can also be interesting. So
Yeah. I think the med spa, I think a lot of activity is happening in the med spa space, but that's just what maybe some little birdies told me. But well, this has been fascinating. Maria, do you want to tell us a little bit about your firm and how people could reach out to you? Because they may have more questions, and really you're the guru on the market and transactions and going to market and selling your business, right?
yeah.
So it's not just, it's sort of like you have that CPA and valuation credential, but you're really, an investment banker and doing these transactions. So how would somebody reach out to you? Can they talk to you about potentially selling if they're somewhere in this space? And then I always say you can then connect them with the right industry person if it really is an industry thing, but maybe give us a little bit more about you.
Yeah, sure. So Caper Hill Advisors, we're a boutique investment banking firm focused on the middle market, lower middle market, technically based out of Chicago. As Melissa mentioned earlier, I live in Boston, and we have managing directors in Michigan, Denver, and a couple in the Chicago area. We also have staff people in Arizona and Texas. So we cover the country pretty easily. We are, heavily healthcare focused, primarily doing sell side advisory, but we have two managing directors that one is a generalist in terms of businesses he works with, and the other is focused more so on sort of facility services, janitorial, landscaping, HVAC, that type of thing. And in terms of getting in touch with me, I think you've been putting up my email, the website. Certainly feel free to email. I think my cell phone is also on our website. So happy to answer questions for people. No obligation. I really want to make sure people have the right information, are connected to the right advisors for their situation, to make sure that they can have the best outcomes for their transactions.
Yeah, absolutely. I mean, I think that, you know, everybody tells people that it's a process, to sell your business. It's not one call and you're off to the races and you're sold in 6 months. So, planning ahead or getting some information, even if you think it's 3, 5, 10 years down the road.
Yeah,
I think there's so much we know from being valuators, there's so much you can do in that time to make a really grand exit and it be a benefit for everyone and it be a joy as opposed to, something happened and now I need to make some decisions that I'm not even prepared to make.
right.
So I think that would be a good reason to reach out to you. Especially, I didn't know you guys did all sorts of kinds of businesses. So
Yeah.
that's amazing.
Yeah, and to
All
your
right.
point, I
Well,
mean, I typically say, 3 to 5 years out, please get in touch with, if not us, somebody, not only us as sell side advisors, but if you're not working with a wealth manager, please start to have those conversations. I just talked with a husband and a wife yesterday. They own several businesses. They have 2 young kids, and they're not working with a wealth advisor. And I said, this is something you have to do. Not only not only potentially working with us to understand the value of what you have today and potentially how you're going to monetize that in the future, um, but just to make sure that you're planning for your future, not only for your kids and education or however else you want to support them, but for your ultimate retirement.
yeah, there's a lot that goes into, seeing what after that transaction, after taxes, after fees that you're actually making. And a lot of times they think coming to the investment banker and the valuator and they're going to know what's going in their pocket. You also need the CPA, you also need the financial advisor. It is a team approach. So I appreciate you kind of helping them understand. And it's a process. Like you're selling your baby,
Yep.
like it's not to be taken lightly. So reach out to Maria if you have questions. And I'm sure we'll have you back again to tell us more about maybe some other health industry. Maybe we need to pick another one as well. So we appreciate you and we'll probably see you soon.
Sounds great. Thank you so much. It's always a pleasure to sit and chat with you.
Thank you.